Something big is happening at CarMax, and almost no one saw it coming. Cars that were selling for $40,000 just months ago are now sitting on lots with $15,000 price tags, and the entire auto industry is panicking. This isn't a random sale or a short-term promotion. This is a full-blown crisis that could reshape how cars are bought and sold in America. So, what on earth is going on at CarMax? Let's start with a big question. Why is CarMax giving such massive discounts? The answer is both simple and terrifying for the used car industry. Over the last 2 years, CarMax and many other big dealers overpaid for inventory when used car prices were at record highs. They bought cars that were worth $25,000 for $35,000 or more, betting that prices would stay high. But when interest rates spiked and new car production started catching up, the demand for overpriced used cars vanished overnight. Suddenly, CarMax was left holding tens of thousands of cars they couldn't move. And those cars aren't just sitting quietly, they're losing value by the day. Every month a car sits on the lot, its value drops, costing CarMax millions in depreciation. So now, the company's only choice is to slash prices drastically just to get these cars off the lot. It's not generosity, it's desperation. They're liquidating inventory to stop the financial bleeding. Now, here's where things get interesting. What does this mean for buyers? If you've been waiting for the right time to buy a car, this might be it. We're seeing used car prices collapse across multiple brands, from Ford F-150s and Toyota Camrys to Teslas and luxury SUVs. A vehicle that once cost $40,000 might now be sitting at $15,000, $18,000, and the prices are still sliding. Buyers who were priced out of the market last year are suddenly seeing opportunities they never thought possible. But there's a twist, and this is where things get dangerous. Some analysts warn that these steep price cuts might signal deeper trouble ahead. If you buy now, your cheap deal could lose thousands more in value within months as prices continue falling. We've seen this before, during the 2008 financial crisis, when car values collapsed alongside housing prices. Many buyers who thought they were getting a steal ended up upside down on their loans. So, should buyers jump in right now? That depends. If you're paying cash, this could be a once-in-a-decade chance to grab a quality vehicle at a massive discount. But if you're financing, you'll want to think twice. With high interest rates and rapidly falling prices, financing a used car today could mean owing more than it's worth almost immediately. The smarter move might be to wait just a bit longer, because the worst of this price drop may not even be here yet. And here's the part few people are talking about: the ripple effect across the entire auto industry. CarMax's discount spiral is sending shockwaves through dealers nationwide. Competitors like AutoNation, DriveTime, and even franchise dealerships are being forced to match these falling prices or risk being left with unsellable inventory. Automakers are watching closely too, because if used cars keep plummeting, it will drag down new car demand. Who's going to buy a $50,000 new model when a nearly identical used one costs $20,000 less? But the real panic might be happening somewhere else, on Wall Street. CarMax's stock has already started wobbling as investors realize what's coming. The company's entire business model depends on buying low and selling high. But right now, they're buying high and selling low, a deadly combination. Analysts are warning that CarMax could face major write-downs on its inventory. And if the market doesn't stabilize soon, we could see a chain reaction that spreads far beyond just used car dealerships. Because when CarMax sneezes, the entire auto finance market catches a cold. Banks, credit unions, and private lenders have billions tied up in auto loans based on inflated vehicle values. Now, as those values crash, lenders are realizing the collateral backing those loans is worth far less than expected. That means potential massive losses for financial institutions. The same type of ripple effect that once started the 2008 meltdown. Wall Street knows it too. Investors who once saw CarMax as a steady performer, a company built on predictable sales and consistent margins, are now seeing uncertainty like never before. Analysts are calling this the first major crack in the post-pandemic auto bubble. Stock traders are already pulling back, hedge funds are shorting auto retail stocks, and some are warning that this could trigger a credit tightening across the entire consumer market. And the warning signs are already visible in the data. CarMax's inventory levels are ballooning. Tens of thousands of cars sitting idle, gathering dust, depreciating with every day that passes. Their financing arm, which offers in-house loans, is seeing delinquencies quietly rising as customers struggle with high monthly payments on cars that are now worth much less than their remaining loan balances. That's a dangerous cycle. Falling car values lead to defaults. Defaults lead to tighter lending kills demand, and demand drops prices even further. Meanwhile, CarMax is trying to spin the crisis as opportunity. Their executives claim this is a temporary correction and that they're positioning for long-term growth. But behind the scenes, insiders are worried. They're slashing acquisition budgets, cutting employee hours, and quietly reducing marketing spend, all signs of a company bracing for a deeper downturn. And consumers are noticing too. More and more people are walking into CarMax locations and seeing once premium cars being sold for what feels like clearance prices. Vehicles that used to symbolize financial status, BMWs, Teslas, even some high-end SUVs, are now being liquidated like overstock appliances. It's shocking to see, but it's also revealing a truth many in the industry have tried to hide. The used car boom is officially over. What's more shocking is how quickly it all changed. Just a year ago, used cars were appreciating, yes, going up in value, something that almost never happens. Dealers couldn't keep cars on the lot. Now, those same lots are overflowing, and the market has swung from shortage to oversupply almost overnight. That kind of violent market reversal doesn't happen without consequences, and right now, we're only seeing the beginning. If prices continue to free fall, smaller used car dealers could start collapsing entirely. Many of them are highly leveraged, meaning they finance their inventory using bank credit. When those cars lose value, they can't pay back the loans. That's how a local problem becomes a national crisis. And here's the really chilling part. Even new car manufacturers like Ford, GM, and Toyota are watching this closely, because if used cars keep crashing, it could force them to slash prices on their new models to stay competitive. That would mean thinner margins, production cuts, and possible layoffs. It's a domino effect, and CarMax is just the first tile to fall. But what no one's talking about yet is how deep this domino chain could go once consumer confidence breaks. Because when average Americans see car prices collapsing this fast, they start second-guessing every big purchase. If that happens, it's not just CarMax or Ford that suffers, it's the entire retail economy. People start delaying home upgrades, travel plans, and even tech purchases, waiting for the next big crash. That kind of mindset can stall spending nationwide, the same way it did during the Great Recession. And we're already seeing hints of that shift. Online car search traffic is up, but actual purchases are down. People are watching prices tumble, but they're afraid to buy, expecting even better deals ahead. It's the perfect storm. Supply is flooding the market while demand evaporates in real time. CarMax is slashing prices just to spark movement. But ironically, those same price cuts are making buyers hesitate even more. Inside Wall Street trading rooms, analysts are whispering that the CarMax collapse could be the canary in the coal mine for the broader economy. Why? Because the used car market has always been one of the best real-time indicators of consumer health. When Americans can't afford, or are too scared, to buy a car, it means confidence in the economy is breaking down. The last time this happened at this scale was during the 2008 crisis. And we all remember what followed. And yet, this time might be even more dangerous. Back then, interest rates were slashed to stimulate spending. Now, interest rates are already sky high. There's no easy fix. Even with $15,000 price tags, buyers still can't afford loans at 8 or 9% APR. Financing a discounted used car today often means paying more per month than what people paid for new cars just 3 years ago. That's how broken the system has become. Meanwhile, big investors, the ones who once saw the used car business as a goldmine, are dumping their shares. Major funds have started quietly reducing exposure to auto retailers, lenders, and even car rental companies like Hertz, which are facing the same collapsing resale values. If this trend keeps accelerating, it could trigger something Wall Street fears most: an auto-backed securities meltdown. See, most Americans don't realize that behind every car loan, there's a massive pile of financial instruments, billions of dollars in bundled auto loans being traded like stocks. When those loans start defaulting, the value of those securities nosedives. That's when banks, hedge funds, and credit unions start losing billions, and the entire financial system starts tightening credit to protect itself. So when you hear that CarMax is selling $40,000 cars for $15,000, it's not just a good deal. It's a warning siren for the entire economy. Because every one of those markdowns tells a story. A story of overproduction, overpricing, and now, overexposure. But here's the biggest twist. While everyone's focusing on CarMax's price cuts, few are asking the most important question of all. Who's going to buy their cars next year when consumer credit dries up and the job market starts tightening? Because if sales continue to stall, CarMax could be staring down something even more catastrophic than falling prices, a total demand collapse. If buyers can't qualify for loans and banks start tightening credit, then even $10,000 cars will start sitting unsold. That's when the real panic begins. Because CarMax's entire business model depends on fast turnover. They buy cars, recondition them, and flip them quickly. But once that flow stops, cash stops moving. And when cash stops, debt starts crushing from the inside out. Right now, insiders are saying CarMax is doing everything it can to avoid a liquidity crunch. They're offloading vehicles at auction for record losses, bundling risky car loans into asset-backed securities, and pushing lenders to refinance short-term debt. It's a financial juggling act, and if just one ball drops, the entire company could stumble. Some analysts even compare it to what happened to Zillow when the housing market turned. Overpaying for assets, misjudging demand, and being forced to dump inventory at a loss. And here's where it gets even darker. CarMax's problems could soon spread to automakers themselves. If used car prices keep free-falling, the resale value of new vehicles collapses too. That means leasing companies, rental fleets, and even manufacturers who offer buyback programs will start losing money on residual values. Ford, GM, and Toyota could be forced to rethink their production plans. Fewer new cars built, slower supply chains, and possible factory layoffs. Think about that ripple effect for a moment. A price cut at CarMax today could lead to a production cut at Ford next month, a supplier shutdown in Michigan, and job losses in Ohio or Tennessee the month after. That's how fragile this ecosystem is. Every link in the chain depends on the next, and right now, CarMax's chain is starting to snap. Meanwhile, Wall Street is watching like hawks. Hedge funds are dissecting CarMax's quarterly reports, looking for clues of how deep this rabbit hole goes. Analysts are warning that if CarMax's margins drop any further, credit rating agencies might downgrade their bonds, making it more expensive for the company to borrow money. And that's the nightmare scenario, because CarMax, like most major retailers, runs heavily on credit. The moment borrowing gets more expensive, survival gets harder. And if CarMax's borrowing costs rise, expect to see even more layoffs and cost-cutting. The company might start closing underperforming locations, halting expansion, and delaying tech investments. That could ripple through the job market, thousands of employees affected, from sales reps to mechanics. But here's the part no one's prepared for. If CarMax's collapse spreads to auto lenders, it could trigger something called a credit contagion. When lenders get spooked by rising defaults, they tighten lending standards across the board. That means fewer people can buy not just cars, but homes, furniture, and electronics. It's like oxygen being sucked out of the economy. And as this tightening spreads, you'll start to see it reflected in consumer sentiment. Confidence drops, spending slows, and Wall Street starts adjusting valuations across retail, banking, and manufacturing. All of this, from a single company's desperate discounts, could snowball into one of the most severe market corrections the auto industry has seen in decades. Because make no mistake, CarMax's fire sale isn't a sign of a healthy market adjusting. It's a symptom of a market that's been living on borrowed time. The easy money era of cheap loans and inflated prices is ending, and what's left behind is an industry built on debt, overvaluation, and now, sheer panic. But what happens if these falling prices start hitting electric vehicles, which already have shaky resale values and sky-high production costs? Because that's the next domino waiting to fall. And when it does, it could completely rewrite the future of the EV market. Because electric vehicles, unlike traditional gas cars, lose value at lightning speed once newer models hit the market. Battery degradation, tech obsolescence, and rapid innovation cycles make older EVs far less desirable. So when CarMax starts dumping used Teslas, Rivians, and Chevy Bolts at half their value, it sends a brutal message. The second-hand EV market might be collapsing even faster than anyone thought. And that's dangerous, not just for CarMax, but for the automakers betting their futures on EVs. If consumers see EVs losing 50–60% of their value in just a few years, they'll think twice before buying one new. That hesitation hits automakers like Tesla, Ford, GM, and Hyundai right where it hurts, in demand. Lower demand means production slowdowns, and slowdowns mean layoffs, factory pauses, and investors bailing out of the electric revolution. Wall Street's already noticing this pattern. Investment analysts are calling it the start of an EV bubble correction. The same way tech stocks crashed in 2001 after years of hype, the EV market could be facing a reality check, one that starts in the used car lots and spreads all the way to corporate boardrooms. And if that correction continues, we could see automakers slashing prices on new EVs even further, forcing CarMax and others into a price death spiral they can't escape from. Meanwhile, behind the scenes, credit risk is building fast. Lenders who finance these expensive EVs during the hype are suddenly sitting on assets worth far less than expected. Banks and financial institutions are quietly tightening credit on EV loans, making it even harder for consumers to buy or refinance. Some smaller lenders, especially regional credit unions, are reportedly writing off losses as repossessed EVs flood the auctions with little to no demand. And for CarMax, that's a nightmare scenario. EVs were supposed to be their next big moneymaker, sleek, high-margin vehicles for a new generation of buyers. Instead, they've become dead weight, sitting unsold for months while prices plunge. Every EV that doesn't sell eats into profits and drives up storage and maintenance costs. It's an operational disaster that no amount of discount marketing can fix. But here's what's even more alarming. Investor confidence in CarMax's entire model is starting to break. Wall Street analysts once praised CarMax's ability to weather any storm thanks to its data-driven pricing algorithms and nationwide presence. But those same algorithms are now working against them. The automated pricing systems that once optimized profits are chasing a falling market, constantly cutting prices just to keep up, effectively racing themselves to the bottom. And this race isn't happening in isolation. Competitors are watching and reacting in real time. AutoNation, Carvana, and countless local dealers are being forced to follow suit, slashing prices to avoid being left behind. What started as a CarMax crisis is rapidly turning into a national used car price war. And in any price war, there are no winners, only survivors. Economists are warning that if this continues through the next quarter, we could see a deflationary shock hit the auto sector, meaning car prices drop so fast that consumers hold off buying altogether, expecting even cheaper deals later. That's the kind of consumer psychology that kills markets. It's what happened in Japan during their deflationary spiral decades ago. And it's the one thing the US economy has always feared. Yet, through all of this chaos, CarMax insists it's adapting to market realities. But adaptation can only go so far when your core business model is collapsing from both sides. Falling prices on one end and rising costs on the other. The cracks are widening, and now the question isn't just whether CarMax can survive this storm, but whether it's about to drag the entire used car industry down with it. Because if the largest used car retailer in America can't stay profitable while cars are being sold at record discounts, then what hope do smaller dealers have? And if those dealers start falling, what happens next to the auto loan market, the repo business, and the financial firms holding billions in car-backed securities? That's the part nobody's ready for, the next chain reaction that's already quietly starting to build beneath the surface. Because once that chain reaction starts, it becomes nearly impossible to stop. We're talking about hundreds of billions in auto loans, lease agreements, and inventory financing all tied together. And if even a fraction of that collapses, it could ripple through the entire financial system. Repossession companies are already reporting record backlogs. Banks are getting flooded with returned vehicles they can't sell fast enough. Wholesale auctions are overflowing. forcing prices even lower. And that's where the spiral turns deadly. Lower resale values mean higher losses. Higher losses mean tighter lending, and tighter lending means fewer buyers. It's a cycle that feeds on itself, and CarMax is stuck right in the center of it. What's worse is how eerily familiar all of this feels. Overvaluation, easy credit, inflated consumer demand, and then a sudden crash. We've seen it with tech stocks, housing, and now, cars. It's the same playbook, just with different products. The system builds itself on unsustainable optimism, and when the music stops, everyone scrambles for a chair. For years, CarMax was the symbol of stability, the safe bet in the used car market. Now it's the warning sign that the entire industry may have pushed its luck too far. And if this unraveling continues, it won't just hurt dealerships and automakers. It'll hit average Americans, because falling car values can crush trade-ins, trap borrowers in negative equity, and make financing the next car nearly impossible. And that's the scary truth. What's happening at CarMax today might be a glimpse of where the entire US auto market is headed tomorrow. The illusion of endless demand and rising prices is gone, and what's left behind is a harsh, uncertain reality. So, if you're watching those too good to be true $15,000 deals pop up online, remember what they really represent. They're not just discounts, they're distress signals, a warning from inside the machine that something much bigger is breaking. The question now isn't just how low prices will go, it's how many industries will fall with them. Because CarMax's crisis isn't just about cheap cars. It's about what happens when an entire economy built on debt starts to buckle under its own weight. Stay tuned, because what's coming next could shake not just the auto industry, but Wall Street itself. Thanks for watching. If you found this video eye-opening, don't forget to hit that like button, subscribe, and turn on notifications, because the next chapter in this story is unfolding fast, and you'll want to see what happens when the market finally hits bottom.